You're listening to the Financial Source podcast on YouTube.
Hi, everyone, and welcome to the Financial Source podcast. We are tackling the incredible tension that's really defining global markets right now.
Absolutely. It's this strange balance where you have the stimulus of a dovish policy pivot.
Right.
But it's being immediately challenged by, mounting geopolitical risks and this new wave of tariff wars.
And this is a critical moment. We're seeing these rapid, almost defensive shifts in trade policy.
Mexico just approved sweeping new tariffs. And at the same time, there's renewed focus on risks around, the Red Sea corridor and the Russia-Ukraine conflict.
It seems like the core of the confusion started with the Federal Reserve. They delivered an expected rate cut, but the 9-3 vote split was surprisingly dovish.
It was. And that split highlights the rising concerns about employment risk and softer inflation, which in turn keeps pressure on global currencies.
So today we're going to break down exactly what that split vote reveals about the Federal Reserve's long-term path.
We'll also look at why major trade developments in the United Kingdom and India are so crucial, and why cross-asset relationships, from gold to copper, are behaving so unusually right now.
This convergence of factors really points toward elevated volatility for the foreseeable future.
Okay, let's unpack it.
Let's start right at the center with that central bank action, because really it set the entire macro tone for the week.
It did. The Federal Reserve cut rates by 25 basis points. On the surface, that looks like a standard adjustment.
Right, but here's where it gets really telling for you as a market observer. That vote split.
Mm-hmm.
A 9-3 split is pretty wide. It suggests, some real internal disagreement. But the tilt was highly dovish.
Highly. One of the members actually pushed for a cut double that size, 50 basis points, while two others wanted no move at all.
That's a massive disagreement. I mean, it's about the severity of the economic deceleration and the urgency of easing.
It is. The fact that one member wanted such an aggressive cut signals deep concern over the growth outlook. They see risks escalating much faster than their colleagues do.
So what drove this surprisingly dovish pivot? Chairman Powell was pretty clear.
He was. He emphasized two specific drivers: rising employment risks and softer inflation trends.
It really sounds like the Federal Reserve is explicitly switching its primary concern from fighting inflation to, supporting employment.
That's the core insight you need to extract from this meeting. It's not about the 25 basis points. It's the signal that the mandate is shifting.
Okay.
Powell said policy is now in a plausible range of neutral. And for the average listener, that just means the Fed believes their tightening cycle is effectively over.
So they think rates are no longer restrictive. They're prepared to step back and let the previous rate hikes work their way through the system.
Exactly.
So if they think policy is neutral and they're openly prioritizing employment risk, you would naturally expect the U.S. dollar to sell off pretty aggressively, right?
You absolutely would. And it tried to. The dollar took an immediate hit right after the announcement. But that language, that shift toward fearing a slowdown, it immediately activated the dollar's other role: the ultimate global safe haven.
So the dollar tried to sell off because the Fed went dovish, but it just sort of flattened out instead of falling further. Why?
Because the market stress everywhere else is providing a massive floor for it, turning it into a safety play. This push-pull is the classic fight in global markets right now.
Stimulus pushes the dollar down.
But fear of a global recession and trade wars pulls it right back up.
And we saw that risk aversion translate directly into currency weakness, especially in what we call high beta foreign exchange.
Which, for listeners, just means the currency's most sensitive to global growth sentiment.
Precisely. The Australian dollar weakened sharply.
And that was compounded by their jobs data, which showed a contraction driven entirely by falling full-time employment. That's a key detail.
Why is that so key?
Full-time job losses hit consumer confidence directly. It's not just a number, it changes behavior.
Got it. And meanwhile, the Canadian dollar, the pound sterling, the New Zealand dollar, all traded softer as that global risk appetite just fell apart.
It feels like the market took the Fed's dovish signal, interpreted it as confirmation of slowing global growth, and then just moved straight into defensive mode.
And that cautious tone was reinforced across the pond. The Swiss National Bank, for instance.
They held rates steady at zero, but Chairman Schlegel publicly refused to rule out returning to negative rates if inflation keeps sliding.
That is an incredibly defensive posture. It signals just deep anxiety about European demand.
It does.
This pressure on the dollar is fundamentally driven by global risk. And speaking of risk, Let's pivot from monetary policy to the massive, aggressive shifts happening in global trade.
It seems like major nations are now trying to wall off their economies from that exact global anxiety.
Defensive walls is the perfect term. What's fascinating here is just the speed and breadth of these targeted trade actions.
It's almost like nations are preemptively preparing for a slowdown by protecting their own manufacturing bases.
So tell us about the Mexican tariffs. This isn't a minor adjustment. This is a massive statement.
It's a huge statement. Mexico approved tariffs of up to 50% on Chinese goods across a wide array of sectors.
50%.
A 50% tariff is not a nudge. That is essentially slamming the door shut. Mexico is making a strategic defensive move to safeguard its domestic production.
And its role within the U.S.-Mexico-Canada agreement supply chain.
Exactly. And there's a complex ripple effect here. Beijing immediately warned these measures would harm the interests of key trading partners.
But the real complexity, from what I'm seeing, is in how intertwined global supply chains have become.
That's the core takeaway. A tariff move between Nation A and Nation B immediately impacts Nation C.
So these Mexican tariffs, they could spill over and hurt sales of, say, India-assembled vehicles from major brands like Volkswagen or Hyundai.
Potentially, yes. Brands that rely on certain Chinese components routed through complex global paths could be hit.
So a defensive move by Mexico to protect itself against China might unintentionally wound India's massive vehicle manufacturing sector. It just perfectly showcases the fragility of the system.
Absolutely. The modern supply chain is a tapestry. And when you cut one thread, the whole thing starts to unravel somewhere you didn't expect.
Meanwhile, the United Kingdom is engaged in its own substantial defensive positioning.
A massive commitment. GBP 1.5 billion in National Health Service medicine spending as part of a broader tariff arrangement with the United States.
That's a huge investment in domestic resilience.
And it's trimmed with the domestic policy shift. Britain will now speed up trade practice investigations and bolster its defensive trade tools.
It sounds like governments are explicitly prioritizing domestic supply security over, the immediate benefits of free trade liberalization.
It's a complete philosophical reversal from the last few decades of globalization.
But it's not all barriers. There are still bilateral deals being pursued.
And that seems to be the new structure. India signaled genuine optimism for finally concluding a trade deal with the United States by March.
So targeted bilateral agreements, rather than these massive multilateral ones, appear to be the new engine of global commerce.
It seems so. We also saw some tentative thawing elsewhere. The European Union and the United Arab Emirates are advancing on free trade talks.
And China actually welcomed the European Union's move to resume price commitment talks, which is a sign of easing friction there.
So if we look at the combined impact here, the dovish Fed signals growth concerns.
And major nations respond by imposing tariffs and strengthening domestic trade defenses.
It means global trading relationships are now fundamentally governed by fear and targeted policy, not liberalization.
Which sets the stage perfectly for the other massive source of volatility this week, geopolitical risk.
We have serious instability across two major theaters, Russia, Ukraine, and the Middle East, specifically the Red Sea corridor.
The Russia-Ukraine conflict has seen a very distinct and strategic escalation.
The focus has moved beyond the front line. It's now clearly targeting Russia's critical economic lifelines, specifically its energy logistics.
This is a major shift. Ukrainian naval drones successfully disabled a vessel in Russia's shadow oil fleet, specifically disrupting transport activity.
That is a direct strike on the logistics needed to move oil out to sea. And it wasn't an isolated incident.
Right. The drones also hit a Lukoil extraction platform in the Caspian Sea,
forcing a halt in oil and gas production there. This confirms the conflict is moving deeper into Russia's strategic energy infrastructure, creating tangible physical supply risk.
So if I'm hearing you correctly, the conflict's strategic focus is changing from territorial gains to economic debilitation.
Which inherently raises the risk premium for global oil. Precisely. Meanwhile, the diplomatic maneuvering is heating up.
The European Union is pushing to extend the freeze on Russian assets.
And Russia's Foreign Minister Lavrov warned that any European peacekeepers deployed to Ukraine will be a target.
That sounds like a firm rejection of any external military intervention, a hardening line from Moscow.
Yes. Though they did reiterate the need for a long-term peace framework, provided it includes security guarantees for all sides.
Classic juxtaposition. Military escalation paired with conditional diplomatic signaling.
Now switching to the Middle East, The tension is centered heavily on aid and logistics.
Washington is weighing terrorism-related sanctions against the United Nations Palestinian Refugee Agency.
And that move would immediately elevate tensions across the region and massively complicate humanitarian operations. It just injects a dangerous new layer of political instability.
And we can't forget the persistent risk at the Red Sea corridor, which continues to impact global shipping.
The United States condemned the Houthis for the continued detention of Yemeni staff. It's a constant daily reminder of the instability in that vital shipping choke point.
We also saw action in South America that ties directly back to geopolitical energy flows.
The U.S. seized another tanker of Venezuela, alleging it was part of sanctioned oil flows involving Iran and Venezuela.
So when you combine these naval drone attacks, the Red Sea risks, and the U.S. seizing sanctioned tankers, you see why global energy logistics are under such immense strain.
Even if the price of oil doesn't seem to reflect it today.
Wait a minute. That takes us directly into the cross-asset stress. We just detailed two major specific supply disruptions, yet oil prices are down today.
West Texas Intermediate and Brent were both down more than $1.
Why is that happening?
This is where you see the market prioritizing one risk over another. Oil is under heavy pressure, not because the supply disruptions aren't real,
but because the bearish sentiment from equities and broader macro uncertainty is just stronger.
So traders are essentially prioritizing the potential for a global slowdown signaled by the Fed over the very real immediate supply disruptions. They're trading growth risk more than supply risk right now.
When the choice is between fear of recession and a short-term supply blip, recession fear usually wins out.
Especially when the Fed is hinting at it.
And these cross-asset relationships are showing serious instability. It's like the market has lost its compass for risk. Let's talk about gold.
Gold is the perfect example of a broken compass. It rallied strongly, but then gave back all its gains as the dollar steadied. What's deeply unusual is that gold is trading unusually in sync with equities.
That feels completely counterintuitive. Gold is supposed to be the classic safe haven. When equities fall, gold is supposed to rise.
So why is it moving with equities now? It signals profound market distrust in traditional hedges.
So investors are no longer using it as a true safe haven, but just another volatile risk asset.
It suggests that if everything is moving together, nobody trusts the traditional playbook. They're struggling to figure out where the next flight to safety will actually land.
As if they're just rotating capital between them based on momentum, not on any strategic relationship to risk. That speaks volumes.
It does. Now, copper is the fascinating outlier here. It briefly surged toward all-time highs.
It cooled off later, but the red metal remains strongly underpinned.
Why is copper so resilient when oil and equities are faltering?
Because it's clinging to the growth thesis, specifically the China growth thesis.
Exactly. Copper supply is constrained globally, and China's policy stance remains supportive of industrial metals and green transition infrastructure.
So even if Western growth fears are peaking, copper is trading on persistent structural demand from the East.
It's the one metal refusing to acknowledge the slowdown.
Speaking of equities, the overall risk tone remains fragile. European indices open lower, U.S. futures are in the red.
The overarching message is clear for you, the listener. The market is struggling to balance the temporary boost of a dovish Fed with the very tangible negatives of global tariff escalation and geopolitics.
Until we see clarity on trade policy or a significant de-escalation somewhere, volatility is likely to remain elevated.
And that combination of defensive trade tools, like the massive 50% Mexican tariffs, and the targeted strikes on critical energy infrastructure, it fundamentally changes the calculus for global markets.
It's no longer just about central bank interest rates. It's about the underlying security and structure of global supply.
And if we connect this back to the bigger picture, all these defensive moves raise an important question. Are we witnessing the permanent fracturing of globalization into regional protectionist blocs?
A provocative thought to end on. If that is the case, the cost of goods and the direction of capital flows will be radically different for the next decade.
That wraps up our briefing on the markets, where global tariffs and escalating geopolitical tensions are driving a cautious tone despite the dovish pivot from the Federal Reserve.
Appreciate you tuning in for this essential market analysis. Join us again soon on the Financial Source podcast.